It S2A. M. You re-scrolling social media. Watching people your age vacation in Bali. Drive Teslas. And live downtown while you read deciding if you can afford name brand cereal this week. Most people believe financial success is primarily about how much money they earn. But this belief quietly keeps them stuck. Income feels like the obvious metric because it is visible, measurable, and socially celebrated. Raises, promotions, and high salaries are treated as proof of progress. Yet income alone does not create wealth. What actually determines financial outcomes is what happens to money after it is earned. Two people can make the same salary, live in the same city, and have completely opposite financial realities based solely on how their money is used. Money that sits idle slowly loses power. Inflation erodes purchasing value year after year, quietly shrinking what cash can buy. This loss is subtle, which makes it dangerous. There is no dramatic moment when savings disappear, no alarm signaling damage. The decline happens silently, giving the illusion of safety while real value slips away. Many people equate savings with responsibility, believing that leaving money untouched is the conservative choice. In a modern economy, this passivity often works against them. Wealth is built when money becomes productive. Productive money grows, compounds, and participates in economic expansion. Instead of being stored, it is deployed. This shift in mindset is critical. The goal is not simply to accumulate dollars, but to position those dollars where they can multiply over time. When money works, effort is no longer the only driver of progress. Time and compounding begin to carry part of the load. The illusion of income-based security is especially dangerous because higher earnings often lead to higher expenses. Lifestyle expansion consumes raises before they ever create stability. Bigger paychecks come with bigger commitments, locking people into cycles that require constant earning just to maintain balance. From the outside, it looks like success. On the inside, it feels fragile. Without productive assets, income becomes a treadmill rather than a foundation. What separates financially secure individuals from financially stressed ones is not intelligence or discipline alone, but understanding leverage, not the risky kind built on debt, but the quiet leverage of compounding. When money is invested, it begins generating returns on returns. Growth accelerates not because effort increases, but because the base expands. This is why small, consistent investments can eventually outperform large but irregular contributions. The system rewards participation over perfection. Savings accounts provide comfort, but comfort does not equal progress. Holding cash can be useful for stability and emergencies, but relying on it as a wealth-building strategy creates stagnation. In contrast, investing aligns personal finances with the broader economy. As businesses grow, innovate, and expand, invested money grows alongside them. This connection allows individuals to benefit from productivity they did not personally create. The key realization is that wealth is not stored. It is built. It is the result of systems working quietly over long periods. People who grasp this stop focusing exclusively on earning more and start focusing on allocating better. They recognize that every dollar has a job, and that job should ideally involve growth. Money becomes a tool rather than a scoreboard. This perspective also removes pressure. When money works, progress no longer depends entirely on constant hustle. Time becomes an ally rather than an enemy. The future is shaped not by dramatic moves, but by steady alignment with growth mechanisms that operate regardless of daily effort. Wealth accumulation becomes less about intensity and more about consistency. Understanding that wealth comes from making money work reframes financial decisions. Spending becomes more intentional. Saving becomes purposeful rather than passive. Investing becomes a habit rather than a gamble. The focus shifts from chasing income milestones to building structures that support long-term stability. In the end, income starts the process, but it does not finish it. Wealth emerges when money is allowed to grow beyond its original form. Those who internalize this stop measuring success by paychecks alone and begin measuring it by progress that continues even when they are not actively working. This shift is subtle, but it changes everything. Many people approach the stock market with the belief that it is little more than legalized gambling, a place where prices move randomly and outcomes depend on luck. timing, or insider knowledge. This perception creates fear and hesitation, keeping countless individuals on the sidelines while others quietly build wealth. The truth is that this mindset misunderstands what the stock market actually represents. At its core, the stock market is not a casino. It is a marketplace for ownership in real businesses that produce goods, services, and profits every day. When someone buys a stock, they are not placing a bet on a blinking screen. They are purchasing a small ownership stake in a company. That ownership entitles them to a share of the company's future success. As businesses grow revenue, expand operations, and increase profits, the value of that ownership tends to rise over time. This is fundamentally different from speculation, where the goal is to profit from short-term price movements driven by hype, emotion, or crowd behavior rather than business performance. The gambling mindset focuses on price alone. It treats stocks as numbers that go up and down for mysterious reasons. This encourages behavior driven by excitement and fear. People chase what is popular, panic when prices fall, and constantly search for the next big win. These actions feel active and engaging, but they disconnect investors from the underlying reality of what they own. When price becomes the only focus, volatility feels threatening instead of normal, and temporary declines feel like permanent failure. Investing, by contrast, is grounded in business fundamentals. It begins with the understanding that companies exist to generate profits over time. Revenue, costs, margins, and competitive advantages matter because they determine whether a business can sustain and grow those profits. Long-term investors care less about daily price swings and more about whether the company is becoming more valuable as a business. This perspective transforms market fluctuations from emotional events into background noise. The difference between speculation and investing often reveals itself during market downturns. Speculators experience fear because falling prices invalidate the hope of quick gains. Investors, however, understand that downturns reflect changing expectations, not the immediate disappearance of productive capacity. Factories still operate, employees still work, products are still sold, and services are still delivered. While some companies struggle, many continue to grow despite temporary market pessimism. Ownership remains intact even when sentiment shifts. Treating the stock market as ownership also changes the time horizon. Gambling demands immediate results, while ownership rewards patience. Businesses do not grow overnight. They expand through years of reinvestment, innovation, and adaptation. Investors who align with this reality allow time to work in their favor. Compounding amplifies results as profits generate more profits, and ownership in growing enterprises becomes increasingly valuable. This process is slow, but it is reliable when given enough time. Another key distinction is control. Gamblers react to outcomes. Investors make decisions before outcomes are known and stick to them through uncertainty. They accept that short-term results are unpredictable but trust long-term trends driven by productivity and growth. This acceptance reduces emotional decision-making and encourages consistency. Instead of trying to outsmart the market, investors position themselves to benefit from it. Understanding stocks as ownership also explains why diversification matters. Owning shares across many businesses spreads risk and aligns returns with the broader economy rather than individual outcomes. This approach reflects confidence in long-term economic growth rather than dependence on specific predictions. It shifts focus from guessing winners to participating in overall progress. The idea that the stock market is gambling persists because speculation is louder and more visible. Dramatic wins and losses attract attention, while steady ownership quietly compounds in the background. Media narratives emphasize excitement over discipline, reinforcing the misconception that success requires constant action. In reality, the most successful investors are often the least active, allowing their ownership stakes to grow undisturbed. When the stock market is understood as a system of ownership, fear gives way to clarity. Price fluctuations lose their power to intimidate, and patience becomes a strength rather than a weakness. Wealth is no longer dependent on luck or timing, but on participation in real businesses over long periods. This shift in perspective is what separates those who gamble with money from those who use it to build lasting wealth. Many people believe that financial success belongs to those who are exceptionally smart, highly analytical, or able to predict the future with precision. This belief creates the impression that wealth is reserved for a small group with rare talent or insider knowledge. In reality, long-term financial success depends far less on brilliance than on behavior. The most powerful forces in investing are time, consistency, and compounding, and none of them require extraordinary skill. They require endurance. Time is the single most underestimated advantage in wealth building. It allows small actions to grow into significant outcomes through repetition. When money is invested and left undisturbed, it begins to generate returns, and those returns themselves start generating returns. This layered growth does not happen quickly or dramatically. It unfolds gradually, often invisibly, until years of accumulation suddenly appear impressive in hindsight. The key factor is not how much is invested at once, but how long the money is allowed to remain invested. Consistency amplifies the effect of time. Regular contributions, made regardless of market conditions, remove the need for perfect timing. Instead of attempting to guess when prices will be lowest or highest, consistent investing spreads risk across different moments. This behavior smooths out volatility and reduces emotional pressure. Over long periods, the habit of showing up matters more than the accuracy of individual decisions. Compounding is often described as a mathematical concept, but its true power is psychological. It rewards patience and punishes interruption. Each time investments are abandoned or altered in response to fear or excitement, the compounding process resets or weakens. Staying invested through uncertainty allows growth to build upon itself. The longer this process continues, the less important new contributions become relative to accumulated gains. Talent and timing feel attractive because they promise shortcuts. Stories of people who bought the right asset at the perfect moment dominate attention. These stories are compelling precisely because they are rare. What is less visible are the countless failed attempts at timing markets and picking winners. For every success story, there are many silent losses. Relying on exceptional timing introduces fragility, because it depends on repeated accuracy in an unpredictable environment. Long-term success favors strategies that work even when conditions are imperfect. Markets experience cycles of growth, stagnation, and decline. No one can consistently predict these phases. Consistent investors accept this uncertainty and continue regardless. By remaining invested through downturns, they participate fully in recoveries. Missing even a small number of strong recovery periods can dramatically reduce long-term results, making consistency more valuable than prediction. Another advantage of consistency is emotional stability. Financial decisions made under stress often lead to regret. A system based on regular investing reduces decision-making during volatile periods, limiting opportunities for emotion to interfere. Over time, this creates confidence not because outcomes are guaranteed, but because the process is reliable. Trust shifts from forecasts to habits. Compounding also changes the relationship between effort and reward. Early on, progress feels slow and discouraging. Results appear disconnected from effort, tempting people to abandon the process. As time passes, growth accelerates, and outcomes begin to reflect years of accumulated patience. This delayed gratification is uncomfortable, which is why many fail to experience it. Those who persist are often not more intelligent, but more patient. The simplicity of time-based wealth building makes it easy to dismiss. There are no dramatic moves or constant adjustments. The absence of excitement is mistaken for ineffectiveness. In truth, the lack of drama is what allows compounding to operate uninterrupted. Complexity introduces friction, fees, and emotional engagement that erode returns over time. In the end, financial success is less about being right at the right moment and more about being present for enough moments. Time rewards participation. Consistency removes the need for brilliance. Compounding magnifies ordinary actions into extraordinary outcomes. Those who understand this stop chasing perfection and start valuing endurance, knowing that steady commitment over long periods quietly outperforms talent and timing combined. One of the most misunderstood aspects of investing is the idea that success requires constant decision-making and detailed analysis of individual companies. This belief creates the impression that investing is complicated, time-consuming, and only suitable for people willing to study balance sheets and earnings reports. In reality, broad diversification through simple investment vehicles has proven to be one of the most reliable ways to build long-term wealth. Rather than relying on the success or failure of any single company, diversified investing spreads exposure across many businesses, industries, and economic forces at once. Diversification works because it reduces dependence on specific outcomes. Individual companies can fail for reasons that are impossible to predict, such as poor leadership decisions, technological disruption, regulatory changes, or unexpected competition. Even strong companies can experience long periods of stagnation. When an investment strategy depends on just a few businesses, these risks are concentrated. By owning a wide range of companies, poor performance in one area is balanced by strength in another. The overall result becomes more stable, even though individual components may fluctuate significantly. Broad market investing reflects the collective performance of an entire economy rather than the fate of isolated businesses. When productivity increases, innovation expands, and consumers spend more, diversified investors benefit automatically. This approach aligns personal financial growth with the long-term growth of businesses as a whole, instead of attempting to identify which companies will dominate the future. Diversification allows participation in that future regardless of which specific winners emerge. Another critical advantage of diversified investing is cost efficiency. Investment costs often appear small on the surface, but their long-term impact is substantial. These reduce returns every year, and over decades, those reductions compound into significant losses. Low-cost investment structures minimize this drag, allowing more of the market's growth to reach the investor. High fees, by contrast, create a persistent headwind that even strong market performance struggles to overcome. Diversified investing also minimizes the need for frequent trading. Constant buying and selling introduces transaction costs, tax consequences, and emotional stress. Each decision creates an opportunity for error. A broadly diversified approach encourages long holding periods, reducing unnecessary activity. Over time, this restraint allows investments to grow with fewer interruptions, strengthening the effect of compounding. Psychological benefits are just as important as financial ones. When investors focus on individual stocks, every piece of news feels personal and urgent. Price swings are interpreted as success or failure. This emotional attachment increases anxiety and encourages reactive behavior. Diversification creates distance between daily market noise and long-term outcomes. Since no single company dominates the portfolio, short-term movements lose their power to influence emotions. This emotional detachment supports discipline. Investors who feel less pressure to act are more likely to remain invested during periods of uncertainty. Market downturns become less threatening when losses are spread across hundreds of businesses rather than concentrated in a few. This resilience is essential during periods of volatility, when fear drives many people to abandon their strategies at the worst possible time. Diversified investing also reflects an acceptance of uncertainty, rather than assuming the ability to predict the future. It acknowledges that economic progress is unpredictable but persistent. History shows that while individual companies rise and fall, markets as a whole tend to grow over long periods. Diversification is a way of aligning with this pattern without needing precise forecasts. The simplicity of this approach is often mistaken for passivity or lack of sophistication. In truth, it is grounded in evidence and experience. Many highly active strategies fail not because markets cannot be beaten, but because the costs, complexity, and behavioral challenges overwhelm potential advantages. Diversification avoids these pitfalls by removing unnecessary variables. Over long periods, diversified portfolios capture the benefits of innovation, productivity, and economic expansion with fewer risks and lower costs. They require less intervention and fewer decisions, allowing time and compounding to do the work. By emphasizing breadth over precision, this approach transforms investing from a constant challenge into a steady process. The result is not dramatic or exciting, but durable, resilient, and aligned with how wealth is most reliably built over time. Wealth creation through investing is often portrayed as a complex pursuit that requires exceptional intelligence, constant monitoring, or access to exclusive information. This perception discourages many people from even trying, because it makes the process seem intimidating and out of reach. In reality, the most powerful driver of long-term financial success is not complexity but consistency. Simple systems, followed with discipline over long periods of time, have repeatedly proven more effective than sophisticated strategies that rely on frequent decisions and perfect timing. A simple investment system removes unnecessary friction. When decisions are minimized, the chances of emotional interference are reduced. Instead of constantly debating what to buy, when to buy, or when to sell, a structured approach creates clarity and routine. This allows investing to become a habit rather than a series of stressful choices. Over time, habits compound just like money does. Small actions repeated consistently produce results that appear extraordinary only because most people fail to maintain them. Discipline is what allows these systems to work. Markets are unpredictable in the short term, and prices move in ways that often feel irrational. Without discipline, investors react to fear and excitement, abandoning their plans at the worst possible moments. Discipline means continuing to invest when markets are declining, even though it feels uncomfortable. It also means resisting the urge to chase performance when prices are rising rapidly. This steady behavior creates alignment with long-term growth rather than short-term emotion. One of the greatest advantages of simple systems is that they reduce reliance on motivation. Motivation is temporary and unreliable, especially when markets are volatile or when life becomes busy. Systems function regardless of mood. When investing is automated and structured, progress continues even during periods of doubt or distraction. This consistency ensures that time remains the primary force driving growth. Cost control is another critical element of disciplined investing. High fees quietly erode returns year after year, often without drawing attention. Simple strategies tend to rely on low-cost investment vehicles, which preserve more of the market's natural growth. Over decades, this difference becomes dramatic. What appears insignificant in a single year compounds into substantial losses or gains depending on how costs are managed. Patience is inseparable from discipline. Wealth accumulation is slow at first, which can make the process feel ineffective. Early progress is often invisible, leading many people to believe their efforts are pointless. However, compounding accelerates over time. The most meaningful growth occurs later, after years of steady investment. Discipline keeps the system intact long enough for this acceleration to occur. Another strength of simple systems is their resistance to noise. Financial news, market commentary, and social media constantly present new opinions and predictions. Without a clear structure, it becomes easy to second-guess decisions and change direction repeatedly. Discipline provides a filter, allowing investors to ignore distractions and stay focused on their long-term objectives. This stability is a competitive advantage in a world filled with constant information. Simple systems also create confidence through understanding. When an investor knows exactly why their strategy exists and how it works, uncertainty becomes easier to tolerate. There is less temptation to abandon the plan during periods of underperformance because expectations are aligned with reality. This clarity reinforces discipline and reduces the likelihood of destructive behavior. Over time, disciplined investing becomes self-reinforcing. As results accumulate, confidence grows, making it easier to stay consistent. The system does not require brilliance or constant improvement. It only requires adherence. This is why simple, disciplined approaches have allowed ordinary people to achieve extraordinary financial outcomes. Ultimately, wealth is not built through intensity but endurance. Simple systems provide the structure needed to endure uncertainty, volatility, and emotional pressure. Discipline ensures those systems remain intact across decades, not just months or years. Together, they transform investing from a stressful pursuit into a reliable process, where progress is driven not by prediction or luck, but by consistency, patience, and time.